In last week's video, we talked about the historical 10-year returns in the S&P 500 given the price people are willing to pay. So this chart up here in the top corner has downward sloping dots, which essentially mean, I'll give you the cliff notes for the whole video, when you are up and to the left, that means you have a higher expected rate of return because you are paying less for an investment. And as you go over to the right and pay more for an investment, your expected rate of return goes down. Now, given that and the current valuations for the S&P 500 over the last 30 years or so, the S&P 500 has returned between +2 and -2% for 10 years when people are willing to pay as much as they are today for the S&P 500. So not great news if you're an S&P 500 investor and you like to look at history. And so the follow-up question is saying, okay, so the future does not look amazing given the current valuations for the S&P 500 as far as my expected rate of return. What are my options? Well, as we look around the world, are other countries as expensive as the United States? So let's look at this chart here and answer that question. So we've got a vertical axis and a horizontal axis. The short answer is as you move up and to the right, it means the countries are getting more expensive. And so you've got these dots plotted, you've got countries all around the world, and then you've got this big dot here, the world, AC, right? That just means that is the blend of all the valuations across the world. And you might be looking around here if you're anything like me, and you might be saying, where's the United States? Well, the United States is, you have to keep going up and to the right, which means more expensive. It is literally off the charts expensive. Okay, so when you look at the rest of the world in terms of what people are willing to pay for these companies, the United States is dramatically more expensive than every other country. So what does that mean? Well, what it means is if you are investing in the S&P 500, at least make sure you have a good hypothesis as to why you think this time it's going to be different. Because like we talked about in our last video, given current valuations, the expected rate of returns are not great, and you have other options, whether it's outside of the S&P 500 in the United States or just looking at other parts of the world, buying future cash flows of companies, which is what investing is. There are other opportunities. And so more than anything, make sure you are diversified and make sure that you know what you own and you know why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.